It's a real pleasure to be speaking with somebody that I've been following on social media with a lot of interest and who captured my attention for quite a long time now. So today I'm speaking with Tavi Costa, portfolio manager at Crescat Capital, and a very dynamic and interesting thinker from social media. So it's really a pleasure today to be speaking with you, Tavi.
Ali Khan, nice meeting you finally virtually, and I'm excited to talk to you as well. I enjoy your work.
Thank you, Tavi, and the feeling is mutual. Let me start, Tavi. If we look at the year's been so extraordinary, and I just wanted your perspective because it seems we're still caught up in the whole virus and this COVID-19. I saw that you guys had a great month in March, off the back of must have been taking a position based on the market and what you were seeing. Can you just start by just describing to me how you see the virus in terms of it, the economy, in terms of where we are in the cycle of it, and your perspective on that first?
Yeah, I think the coronavirus situation, the spread of the virus, certainly was an accelerator of what we were sort of saw it coming in terms of the downturn of the business cycle. And the fourth quarter of 2019 already had corporate earnings already declining here in the US, which was already alarming way before all this virus spread. So now the virus spread certainly accelerated the issue. We have now death rate sort of lagging, I would say. That should be accelerating soon. Some areas of the world, like Brazil, is just starting to spread in some new cities. It's a very different type of spread than here in the US, in which we're seeing another acceleration of the still first wave of the virus. When we look here in the US, I mean, certainly the fundamentals are not improving a lot since we've had one of the worst depressions or recessionary kind of macro indicators coming out of all this issue with lockdowns and so forth. Restaurant bookings here in the US are still down 60+% year over year. If you look at globally, we're still also down 60+% as well annually. So we're slowly improving, even when you look at TSA travelers right now. And it's not justifying the rally that we're seeing in the equity market, in my view. When you look at the equity markets, we're record valuation, record leverage. At the same time as you have corporate bonds yields is still at record lows. It makes no sense. And I think the biggest change that we're seeing now is more in the consumer behavior. And I think they're embracing more of the savings approach. And it's going to trickle down to slower improvement in the economy and this lack of organic growth in the economy in general. So I think we're going to need further stimulus and further government assistance to continue to see a pickup in even asset prices overall. So this dependency will probably remain on liquidity, in which, in my view, is all positive for things like gold and precious metals.
You're very bullish about it, and I must say there was a time when we had a big wobble in the gold market, and it was your tweets that kind of gave me a degree of comfort. Can I go back to a couple of points you just made? You said you probably expect more liquidity. So are you saying that you think it's going to be more of the same out of the Fed? I saw a tweet from you saying if they stop printing, the stock market collapses. So, given that we're going into an election, are you forecasting more of the same, a more rampant money printing at the speed with which we saw it happen since the virus hit?
I do, because I think the only way we would see a stop of money printing would be if we do have organic growth. And I'm not sure that's going to be the case in the following months, especially because some of the numbers in labor markets and other parts of the economy are still incredibly bearish. And I think it will take some time for us to see an improvement. When you look at companies, they're still reluctant to spend capital, and estimates for CapEx is still plunging. So it's very hard to see, companies spending money and returning labor market strength that we had prior to this decline in equity markets. The two options that you were referring to in that tweet, it's an interesting idea because I think that that's definitely what's happening. I think the Jay Powell and the Fed is painted into a corner. in which they do have unlimited power of QE and all that, but they have to make a choice. Either they're going to be printing money the same speed that they had in the last few months or weeks, in which we had gold surging because of that, or we're going to see a return more back to normalization of the balance sheet situation, in which would cause the markets to collapse or at least completely slow down the recovery. So what do you prefer? I have no idea what they're going to take in terms of an option. I do have sort of an opinion. I think they will continue to do it as much as they can in terms of equity markets and try to support the equity markets and valuations as much as they can. But honestly, I think that that's just going to make gold and miners and silver to take off. And that's kind of what we're seeing right now. It's the whole idea of buying gold and selling stocks, in my view. If you find two ways that are very asymmetric of taking this and position yourself in a trade, even if you're wrong and the markets collapse and miners decline, I still think that you can find a lot of very overvalued businesses that will decline even further, and you may make up on your shorts. On the other side would be if the markets continue to go up, I think miners are just going to outperform the markets massively, which is something we've seen so far. If you think about in the last quarter that we had in the second quarter, miners are up over 65%, which is the best quarter ever for this industry. And it's over 44 percentage points over the S&P 500. And if you look even tech stocks, it's over 30% of outperformance on that. So, it's incredible to me. It's still the opportunity in that industry and a symmetry with that trade of, if you're right and the Federal Reserve continues to put liquidity in the markets to fund fiscal stimulus, that's the important part. It's not so much are we seeing liquidity. Overall liquidity, in my view, is actually we're seeing a withdrawal of liquidity, not so much because of the decline in the balance sheet recently, but because of the net treasury issuance that we're seeing from the government. So the Federal Reserve has to fund the fiscal stimulus. And I think that's, the level of indebtedness, it will certainly become an issue in terms of liquidity more and more going forward. It's the whole reason why I don't believe we're going to see organic growth anytime soon.
Let me now take you back to some other tweets which you were tweeting about, which caught my attention a few months ago. You were talking about China. And in those tweets, you were highly skeptical of the growth that we've seen over the last decade plus. You were making a correlation between commodity prices and saying that if we'd really seen that kind of growth, we would have seen much more robust performance out of the commodity complex. Can you tell me a little bit about how do you see the Chinese economy right now? I mean, and also then how do you see what has become a very adversarial geopolitical backdrop in 2020?
Yeah, I remember the tweet you were referring to, because for me, it was astonishing to see that the performance of commodities. And when you think about commodities that had one of the worst decades ever, and who is the largest buyer of commodities is China. And how in the world that happened if China was growing at a level that they had been reporting, which in our view is absurdly inflated. But I think the biggest issue in China became really when we started researching more of the property developers in China and the issues with the infrastructure situation there. I think we calculated close to $300 billion of losses of the property developers in China. And at the same time as they accumulated close to $650 billion of net debt. With that puts into perspective of what's happening there in that region. It's a massive infrastructure development at the same time as there's not much of a productive assets in that region as well. There's a whole idea of the Thucydides trap of Grant Allison, which also is important when you have a rising power challenging established power, which is here in the U.S. And those, 12 out of 16 or so, we actually led to a war. I think we're not going to see a physical war, but certainly something that looks like a Cold War. And, when you look at the underlying part of the economy in China, the amount of its banking system certainly is out of whack compared to the size of the economy. We're seeing somewhere close to 3 times the size of their economy in terms of banking assets today. That's just on balance sheet assets. And every time we've seen this throughout history, which actually is unprecedented, the level of imbalance that we have there. But if we just go back to other imbalances that we had, that's certainly aligned with other massive credit bubbles that we had too. Now, when you look at more, in the current account issue in China, which I think was something we've seen also with emerging markets having issues with their currencies. So usually when you have current accounts shrinking, that usually tends to pressure their currencies to devalue as well. That's certainly what we're seeing with China. More recently, it was related to exports. And now what we had was more of a favorable move, but that was just because imports have been plunging in China recently. When you look at iron ore imports, they're heading south again more recently, which is not a good sign. We see disposable income in China still just plunged to its worst level ever. And still, when you look at the interest rate differential in China, it's still very favorable. More recently, we have 10-year yields in China surging, and compared to U.S. yields, and we still see a lot of weakness in the Chinese currency. More recently, we've seen some sort of strength in that, but I think still the trend is still to a significant devaluation in the Chinese currency. When we look at the even personal mortgage numbers in China is still declining significantly, and the inflationary problem I think is the biggest one, because when you have the levels of debt imbalances and credit imbalances that we have in China, I think we got to think about the cost of capital, and inflation, especially food inflation, is still about 11% there in China, which is it's a pretty significant level for its households. And it's pork prices that are mostly driving that, still close to 80% year over year on that of the CPI for pork prices. So the cost of capital is still rising. And you have the whole situation, the political issue with Hong Kong and Taiwan. I think that's all is still something that's still heating up. Obviously, 2 weeks or a week ago, the situation with Hong Kong got a little worse, intensified the issues, geopolitical issues there. And you have now Australia having issues with China too. Australia and Canada are both economies, and Hong Kong obviously, that have very strong ties to the Chinese economy. And it's important to look at their real estate markets in which are having issues today that I think are all related to the outflows that we're seeing from high classes in China. So I think that's all related to the issue. In our view, what's going to happen with China is the whole idea of the macro trade of the century, of buying gold in renminbi terms. Empirically, that's what tends to work when you have an emerging market, a credit bubble bursting. And I think that's probably what's going to happen. It's been happening already. Gold in renminbi terms have been rising. I think it's going to continue that way. So I think that's the way we're playing here at Crescat. There's a lot of very low implied volatility in the Hong Kong dollar, and still in the Chinese currency more recently because of the strength of the yuan versus the dollar. And that's a good time. It's a good entry point right now for you to look for shorts in that currency.
Is that your most compelling trade right now? Gold financed in renminbi or the Hong Kong dollar, would you say?
It's very hard to say the most compelling trade. We look at that as 3 legs of a portfolio in the global macro fund, which is being long gold and precious metals and miners, being short the Chinese renminbi and the Hong Kong dollar, and also being short some of the most overvalued stocks here in the US and some other places in the world. Those 3 legs, like in the last quarter, what worked was precious metals, no doubt. The other parts of the leg didn't work at all. And that was enough to offset the losses on the other legs, and it was why we had a great quarter. So I think that the beauty of it is asymmetry of those 3 legs, and how you can really position yourself in a way that you don't have to get all those 3 legs correct. But I believe that we can certainly get the 3 legs correct. Is the whole idea of that macro trade of the century of being long gold in renminbi terms and being short global stocks. That has been working for the last year or so since we put out this trade as our highest conviction trade for the last years. And I think that it's going to continue to work, regardless if it is just boosted by one of the legs of that trade.
let me take you now to emerging markets, because if you look at the sort of emerging market story going all the way back to the BRICS story, you know, the last 2 decades has pretty much been a sweet spot for emerging market investors. You know, one could say until recently. How do you see emerging markets? They've had a horrendous currency devaluations, recovered a little bit recently. Are you a bull? Are you buying into the story that the dollar starts to soften up and we get a bit more strength coming here? Are you seeing the China pull effect now in reverse, or do you still see it being there? What do you think of the emerging market universe?
You know, that's a very interesting question, because more recently we've seen the sentiment for Chinese equities especially change quite a lot, as you know. Yeah, it dramatically shift, and I don't understand why, because I don't think the narrative has really changed in my view. It's, at least when you look at macro indicators, like MCHI, just an ETF for China, Chinese equities, the 14 RSI was one of the near record levels. We've had CSI 300. If you look at RSIs, there's one of the largest amounts of stocks above the 70 RSI. And more recently, we just had the government pension funds announcing they're going to be trimming some of their holdings in equities, which is a complete shift from 2 days ago,
Yes.
where they're asking households to be buying stocks. So it's quite interesting what's happening there. Chinese small cap stocks have been underperforming the large cap stocks by quite a lot, especially more recently. And large cap are trading at much higher value, not much higher, but higher valuations than 2015 on that peak when we had that speculative bubble back then. I think the last time I checked was somewhere close to 14 times EBITDA in aggregate terms, the large cap Chinese stocks today. A small cap, it's not as high, but it's still 68 times EBITDA. So it's significant. I think, I still think that, cyclical commodities will kind of lead, especially places outside of China, like Brazil, that have a very high correlation to cyclical commodities on a year-over-year basis. I know we've seen copper kind of improving recently, but I think that's just a moment, just a short-term move in my view. I don't think that that's something we're going to be seeing that is going to be sustainable. So, the devaluation of currencies is the biggest issue for emerging markets. The shortage of dollars because of the amount of liabilities denominated in US dollars are still, a huge problem outside of the US. And more recently, we've had the dollar depreciating versus other currencies, and I think that kind of alleviated some of the issues. But, we could certainly see that coming back as a problem in 1 or 2 months from now. I think that that's a window, a great window for a lot of funds and investors to be looking at ways of being long the dollar today. And again, doesn't mean I'm long the dollar, I'm short gold. No, not at all. I'm long gold versus the most overvalued currencies in the world that I view. And I think emerging markets certainly fall into the category of that. So anyways, I think that the Brazilian real, for instance, is still poised to go to the value much further. I think we're going to be above 6 handle in Brazilian real by the end of the year easily. And right now it actually took off recently. It devalued significantly and then appreciated a ton in the last month or so. And more recently has kind of coming back to the value, devaluing again. But I think we're just at the beginning. It's been a consolidating chart, and I think it's just going to take off soon again. The same goes for the Chinese renminbi, and the same goes for other places like Argentina, Colombia, Chile, and so forth. I think those are all linked to China still. I think the whole answer you gotta be looking for is, are we going to see organic growth globally or in the U.S. That could shift? Usually what you see is that the emerging market currencies, when they start really sustainably appreciate versus the dollar, is the time when you see the world improving in terms of growth. I don't think we're going back to that. I think given the levels of debt, not only in developed economies, but also emerging markets, will still be a problem going forward. And the virus is just something that is just, it's a true uncertainty that nobody knows. I'm not a doctor. It's very hard to analyze that part. But I believe that it's still going to be among us for some time. And it's just, a huge detractor of this possibility of a growth scenario going forward. So I'm still bearish on the emerging markets. I have not changed my view at all, and I think that the cheap valuations relative to U.S. equities just makes me not short emerging market stocks, but also be short more of the U.S. stocks, but also be looking for ways of shorting emerging market currencies instead, especially the ones that have very low implied volatility today.
So what has the lowest implied volatility for you at the moment in the emerging market?
Well, certainly, which is not an emerging market, it would be Hong Kong dollar would be one that you can risk some bips of your performance every year or every quarter, depending on how you want to structure that trade, and still get a significant exposure. Today, we have somewhere close to over close to 900% of our portfolio in Chinese and in Hong Kong dollar exposure today, and it's something that is costing us a lot to put that trade on. 900% of our NAV is on that trade. So, when we have a bad quarter or month in that trade, it's not something that's been costing as much in terms of performance. So I think that's one way to look at. We've recently been adding to our shorts in those parts. So that's the beauty of having three legs. When one leg starts to not work in a big way, which has been the case with the Chinese renminbi, well, that's an opportunity to add to those trades. And more recently, we had gold working incredibly well. So we pared down a little bit on those and added to the other leg that hasn't been working yet. So I think that's the way we think about the world in the following months, at least in the following year or so. I'm not sure if we're going to be changing our position anytime soon. We haven't really seen the whole real global recession unfolding in a more in a longer period of time here. This is such a short-term problem that we had, and now it looks a lot like for a lot of investors that things are going back to normal. We're even seeing some more euphoric sentiment more in the markets that makes no sense with record valuations and low corporate bond yields. So all that is not matching. And I think there's a lot more for the macro trade of the century in terms of the following months to work out.
Tavi, thank you very, very much for spending the time with me today. I really am grateful, and thanks so much for giving us a very clear perspective on how you see the world.
Well, thank you, Ali Khan. I appreciate again your invitation, and I was glad to get to know you again here, and thanks again for the opportunity.
It's a pleasure, and it was a real pleasure speaking with you today. Thank you, Tavi.
Thank you.
Thank you.